G'day everyone, and welcome back to this ShareCafe Hidden Gems webinar. It's probably one of our most important webinars this week as we discuss an industry that will ultimately change all our lives. We're fortunate to have brought together some industry experts. We thank them all for their time. All these experts share the vision that the EV battery will help reduce greenhouse gas emissions in the future and power our future. That said, to get there, we still require technological advances, massive increases in raw commodity supply, and billions of dollars in funding. Now, for some economies like the US, a supply chain for building battery technology is only just beginning. So for our CEOs presenting today, they are really at the forefront of these technological challenges. And for investors, new battery technology creates new investment opportunities. You only have to realise the extent of the opportunities by looking at the share price performances of some of the companies presenting today. Right, if you want to ask any questions, just type questions in the box provided. Don't put your hand up, we can't see you. All these webinars will be on YouTube tomorrow and on the ShareCafe website this week. Okay, let's make a start and get straight into it. We've got lots to get through. We welcome Benchmark Minerals. Now, Benchmark Minerals, if you don't know, they're a reporting agency, a proprietary data provider, and a market intelligence publisher for the lithium-ion battery to electric vehicle supply chain. Now, their services are relied on by all the major players in the EV supply chain, including some of the companies today. Our EV analyst uses them. They have testified to the US Senate multiple times, advised the White House, the Pentagon, and government agencies around the world. We welcome their senior analyst, Cameron Perks. Cameron, over to you, thanks.
Thanks, Tim, and thanks for having me here. Since I've only got 10 minutes, I'll jump straight in. This slide basically outlines what we do here at Benchmark, from mine to EV throughout the supply chain, just keeping in mind that the materials we cover are not just primary, processed, commoditized minerals. These are specialized materials which feed into other specialized end uses. The key part for us is collecting first-hand data from market participants on weekly, monthly, quarterly basis. This could be pricing, volumes, numerous other things, allowing us to do our robust analysis that we do on repeat. But the best way to find out more is to contact me or reach out via the website. Next slide, please. What are we all here for? What are the driving forces behind the lithium-ion economy? We're calling it a lithium-ion economy to describe what is happening and to describe what leading economies need to do, not just build massive lithium-ion capacity to fuel EV and storage, but also the upstream, which starts with raw materials, and the downstream, of course, building the EVs themselves, the platforms, recycling, closing the loop. That's what we mean by that. We don't just see China doing it now, not just Europe replicating that, it's also North America, especially the US, building a complete economy, which includes massive battery capacity. Let's take a step back. What are we building with? What are we building a lithium-ion economy for? First, the concerns around the environment, sustainability, circular economy, driven by scientific data. These concerns are increasingly influenced. They're influencing investment sentiment as well as government decisions. Supply chain security concerns, as well as demographic changes, are reinforcing these concepts, these concerns, and speeding up a change in government policy and investment decisions. These government policies are arriving in the form of criticality analyses, foreign investment laws, and most importantly, emissions laws. And while ESG and demographic changes are influencing money directly, investment decisions are also being largely affected by government measures. Because one of the largest emitters and one at the forefront of all of our minds is the auto industry. It's been the target of investment, regulation, demographic demand. It's a big industry, and the need for them to be carbon neutral means that we need a lot of batteries, resulting in the figures on the right. And that's just being pulled from the latest monthly mega factory assessment that we do, where we're tracking over 200 sites. Just 5 years ago, this was something like 10. So things have really blown up. And next slide, please. This is best exemplified by lithium. As you can see, lithium demand did a 180-degree change in just 5 years. We expect demand from lithium-ion batteries to continue growing to 2030 and beyond. Next slide, please. From 2020 to 30, we're expecting an increase of 22% CAGR in demand, and it's going to be hard for lithium to keep up. This has been due to multiple factors, but we are calling this gap the great raw material disconnect. Operating mines will make up less than a quarter of the output expected by 2030. And if you account for all the projects financed and unfinanced, you still won't hit that demand growth in 2030. This year, lithium is just about balanced, but we are seeing the beginning of the deficit. And we think for multiple reasons, this will be sustained going forward. Now that's important. I want to pause there because you won't have your electric vehicles if that's the case. That's most important if we go back to tackle the fundamental drivers behind this movement, which is emissions, but also to stave off competing technologies like sodium ion. So it's really in the best interest of the industry in every way to close the gap in the great raw material disconnect. Next slide, please. Flake graphite. It takes 2.2 tons of flake graphite to make 1 ton of anode. I've put the flake numbers here, a gap increasing and requiring new projects to come online. Next slide. The other key thing for the 2030 raw material disconnect is that the proportion of flake graphite going in to make batteries will grow significantly. The influence of lithium ion on flake graphite will significantly increase in the coming years. Next slide. Cobalt, an important one, it's going nowhere and the gap is increasing. The gap between operational supply and demand will be larger than the entire market is today. Next slide, please. And already an important part of lithium-ion batteries, the proportion of cobalt is decreasing, yes, but it continues to play an important role in the safety of those batteries. There are LFP battery plants being built, of course, and they are good for lower range costs, but NCM will be the dominant chemistry for the foreseeable future, particularly in Europe and North America. Next, please. Now, nickel. This is how we view nickel sulfate. That's what's going into batteries. The gap is increasing there. And importantly, next slide, please. One which you may not know is that battery demand will be the fastest growing sector in the nickel industry out to 2030 and beyond. Next slide, please. Where's it going to come from? It's going to come from everywhere across the world. Disruptors are essential. New companies are essential. Otherwise, we aren't going to be able to do what we need to do. It's also important to note that costs are essential. Of course, raw materials are actually becoming a larger percentage of the overall costs of the batteries as they get cheaper themselves. On the other hand, we are going to have to balance lower costs, a drive to reach demand to fill the gap in the great raw material disconnect with supply chain security and localization of supply, those considerations, as well as ESG and sustainability considerations. Next slide. ESG considerations are important even if you, and there aren't many anymore, even if you don't believe in climate change. ESG encompasses social and governance factors. ESG awareness really just highlights good risk management practices. In fact, there was a study done recently that showed that companies who were improving their ESG reporting were also more likely to be improving on their value of the company at the same time. So it probably shows something about improving practices and risk awareness throughout that company. And next slide, please. In summary, there are a few raw material realities I wanted to highlight. Scaling supply chain quality and quantity is the challenge. Quality in terms of impurities and so on, but also ESG considerations and the quality of the company. Next, the slowest link in the chain, which is the mining and extraction side of things, is starved of investment. Take a look at this graph on the right, and you will see that there is a huge amount of time needed to bring product to market overall. But one of the longest, most time-consuming and underappreciated parts of this is the mine. And I think particularly the approvals process, the mine and chemical processing of lithium particularly is underfunded. The EV revolution is underway. Tesla's CEO, Elon Musk, declared this week that the electric car market is at a global inflection point. The company just delivered its first billion-dollar quarterly profit. The next point is that there is no geological shortage of any of the minerals I've listed in this presentation, but there is often a shortage of investment and good technical knowledge. It's also a young industry growing fast. The next point would be that the future tech will likely be lithium-based. That demand, the investment sunk into this technology is so far ahead of anything else. The next point is the lithium-ion battery is now geopolitical. China has shored up a lot of the supply chain and countries are responding. And lastly, supply will need to consider ESG factors, not just emissions, but water and social impacts too, as we are already seeing demand from the EV manufacturers who are increasingly entering into contracts upstream. We have good visibility there at Benchmark. And next slide, please, just to finish off. And if anybody has any more detailed questions, please forward them to the email there. Thank you.
Thanks, Cameron. Short and sweet. Just some questions here. Charging at home, can you speak to, is there a bigger opportunity outside EV, and can you speak to kind of the demand coming from the home and from the grid?
I'd direct a more detailed answer towards my colleague Andy, who's actually working currently on a battery recycling report, and that will encompass things like second lifing those end users. It's definitely something we've already put into our supply and demand projections, which is what we think is going to come from second life, secondary supply. We've seen in our conversations with OEMs and suppliers and battery manufacturers that they're all interested in how can we reuse EV batteries in home storage, for example, as another life for those batteries. And that potentially has negative supply implications. It's potentially extending the amount of time before it comes back into the supply chain in a circular economy.
And do you have any more color? Do you have any color on at all on the manganese market as a component of the battery?
Oh, I did actually think that as I was presenting, but I hope Marco will be able to fill in all those gaps there. And to be honest, I wouldn't have the confidence to present on manganese. My role is mostly focused on lithium, and sure. But we've got the guys internally who can answer any questions if someone would like some background. Yeah.
And did you say you're putting out a report on recycling and what role that will play also?
Yeah, exactly. So we of course we have our own internal demand projections and supply for recycling, but we want to get a bit more granular on that as it becomes more important. Right now, it's not obviously too important and not making up a huge chunk of supply, if any, really, outside of China. But of course, it's going to become, and if you have a look at our projections, is an very important part of supply in the next decade, 10 or 20 years from now. Yeah.
And finally, there's a question here. Lithium-ion batteries with their nickel and manganese-rich cathodes will be the dominant cell format for some time to come. Can the upstream actually develop in time to meet your lofty demand profile? And what are the kind of key risks to an effective rollout that you could see? Yeah,
and I think so. It's just going to take a bit longer than the current EV manufacturers think it will, and the amount of time that they think it will take to develop some of the upstream supply that will feed into these batteries. That there's some really lofty ambitions out there, carbon neutral by 2030, or some other nice round number. We're only just starting to see the downstream investment come in, sort of from the EV manufacturers down into the mine sites. You see it with BMW and so on entering into supply chain contracts. So that will help, definitely. And hopefully that answers the question, Tim.
And what about the five metals you mentioned? What is the one with the highest deficit demand over the next 5 years? It's always been spoken about. Nickel, what's your thoughts there?
Yeah, and personally, because I'm the lithium analyst, I like to think that it's lithium in a sense, because potentially there's a lot of supply hiding behind the nickel numbers in terms of the larger nickel market. But in terms of nickel, you've also got a lot of supply coming in, and I'm sure Stephen will talk about it. Nickel coming in from Indonesia and various places with dubious ESG credentials. And I think that's really important thing to note, that it's not just also supply and demand and the gap. It's where OEMs and EV manufacturers are demanding that their lithium and nickel come from, and what's the actual CO2 emission, water and social impacts cut off on some of those, and will the suppliers be able to meet that? Of course, you need everything you can get your hands on at this point in time, and for the next 10 years, beggars can't be choosers. But you do see, and there's no preference in terms of pricing right now, but there might be a preference in terms of companies that will be able to attract the best investment and the best partners.
Great, Cameron. That's all we have time for. Really appreciate your time. Have a nice weekend.
Cheers, Tim.
Okay, next up, we welcome back Novonix, ASX code NVX, market cap of 1.1 billion. The company is an integrated developer and supplier of high-performance materials, equipment, and services for the global lithium-ion battery industry, with operations in the US and Canada. The stock has had a one-year return of 134%. We've just put out a research report, which is available on ShareCafe and on Corporate Connect, if you want to read that. We welcome back the CEO, Dr. Chris Burns. It's very late at night there. Chris, thanks for your time.
Happy to be here, Tim. Thanks for having me back. And just as Cameron said, we'll dive right in with the short presentation that we have. So today I want to introduce Novonix to people who may not be familiar with the company, what we do as a group, talk about really the last 6 months, some really notable events and announcements for the company. And going on the back of Cameron's presentation is great to continue to emphasize not just the entire market momentum, but really our focus in North America and the huge growth that's coming in the market there. And then we'll spend the most time speaking specifically about our Novonix Nanomaterials business, the performance, the importance of the technology, and the growth plans for that business. So we can move to the next slide. And when we look at Novonix as a company, as Tim said, we're a provider of battery materials and development technology. We're focused on better performance battery systems, which for us means longer life and lower cost. When you look at supporting the EV and ESS sectors, there's been so much progress in improving technology that really the key impediments still to driving even further adoption are the cost profile of the batteries and how they relate to the vehicles, and how that ties back to what life can come out of those as it relates to the vehicle life, as it relates to even second life opportunities, as was mentioned. But those really become key factors. And at the base of our business is our battery technology solutions business. It was founded around the most accurate battery testing technology to more quickly determine life cycle assessments of battery technologies. And we use that to evaluate new materials, our process technology, work with the industry. And we founded our Novonix Nanomaterials business in 2017 with a focus on developing synthetic graphite technology to support long life, low cost batteries, utilizing our technology to develop the process. And we've become the only qualified supplier of this material in North America, starting to scale. And we'll talk about that later in the presentation. But outside of our Novonix Nanomaterials business, things we won't talk about today, we continue to use our technology solutions business to develop new process technology, new technologies that we think will create value across the ecosystem. This includes recent work we're doing in cathode process technology for dry synthesis of high nickel cathode materials to reduce the cost and ESG profile, as well as our energy storage partnership with Romero Technologies. So if we look at the next slide, our group is led by myself as the CEO. I have a PhD in physics, been working in battery material chemistry for over the past decade and more. I led a team at Tesla for 2 years working on battery materials and run our group of companies. We've started to build out our team, our corporate team, including many new hires in the United States as we begin scaling the business there. And as technology is at the backbone of our company, we've recently announced that Jeff Dawn has joined our group as our chief scientific advisor. He's a notable researcher across the world in the lithium-ion space. He's spent the last 5 years, his research group at Dalhousie, working exclusively with Tesla, and joined our team July 1st as our chief scientific advisor. And Dr. Mark Obervacher, professor at Dalhousie, whose group we sponsored and entered a new sponsorship agreement for the next 5 years. Our board of directors is primarily Australian-based, most notably Andrew Liveris and Trevor St. Baker, formerly of Dow Chemical and Power, respectively. And Admiral Bob Natter is a US-based executive director focused on this US growth narrative that we'll touch on. On the next slide really looks at this key differentiating battery technology solutions business unit that we have. This group works across the battery sector with companies from the raw materials sector through to the EV and ESS OEMs. And what this does is it gives us an extremely unique perspective on where the current state of technology is, where the demands are coming for the end users, and where the new process technologies or new battery technologies are in terms of state of development. And it's really critical with such a rapidly evolving space as lithium-ion batteries to be able to have this type of visibility as we look at where to direct investment within our group for new research and development initiatives, as well as scale up, most notably with our anode materials business, our cathode materials technology, and our energy storage partnership. And on the next slide, when we look at how this operates within the company, our battery technology solutions business is where we do all of our battery prototyping, testing, design, development, validating the performance of materials for all of our internal and external projects. We have a full battery line in-house, thousands of test channels, people working there all around proving the technology and using this testing technology that we developed to more rapidly get these research and development results and feedback to our other operating groups. So in our Novonix anode materials business, this is where we make and produce synthetic graphite for use in lithium-ion batteries. All of those materials are tested and analyzed within our technology solutions group and fed back to our materials processing team within that group. And that rapid research and development ecosystem is what's let us bring that technology so quickly to agreements with Samsung and Sanyo, and now the position that we're in around starting to scale large volume production of this material in North America. And as I said, unfortunately, we don't have the time to speak about it, but using this ecosystem to develop new technologies in the space around our cathode technology and energy storage partnership as well, and things further in our research and development pipeline. So on the next slide is an outline of the past roughly 6 months of it's been a very exciting time for the company, really positioning us for this huge growth that's coming over the next few years. So in December of last year, we announced our strategic partnership with Harper as our furnace manufacturer for our new furnace technologies, and that our second generation furnace technology with them will be used in our Samsung contract. In January, we announced that Jeff Dawn was joining as our chief scientific advisor, as I mentioned, and also the Department of Energy awarded us a roughly $5.5 million grant to work on our third generation furnace technology, and we'll speak a bit about that later as well. We announced our renewal of a 5-year partnership with Mark Oberbach's group, our technology partnership with Romero Technologies, and we raised about $131 million to fund our first phase of growth in the anode materials business. In April, we completed the installation of our first Gen 2 system. In May, we announced our intention to file a secondary listing through an ADR program on the NASDAQ to be listed in the North American market. And last month, we announced the intention to purchase a 400,000 square foot manufacturing site in Chattanooga, which we closed on 2 days ago. So on the next slide, really links to what Cameron was talking about, this huge growth that's coming in the industry. And as he made a point that they're tracking over 200 projects now that a couple of years ago was 10. This is a list of announced factories in North America that add up to about 350 gigawatt hours. And even 6 to 9 months ago, that number was only 250. And this still doesn't have things like the recently announced or planned Samsung plant that will be in North America as well. So we're really entering this extreme growth phase in North America, and we position the company to be scaling right into that. On the next slide shows our operations. We have 2 sites in Canada where we have about 40 employees where we do all of our research and development work, as well now 2 sites over 500,000 square feet in Chattanooga with 30 employees, which is going to start growing very rapidly as we bring capacity online. The next slide shows a bit about the performance technology. When we specifically look at our anode technology and think about our long life, lower cost initiatives and compare the performance compared to commercial synthetic graphite and natural graphite, you can see in our Coulombic efficiency testing in 10 to 20 cycles, we can see differences in the performance of these batteries that over 1,000 cycles are amplified in standard testing conditions. And this really speaks to the performance that's needed for these long life applications and the benefits of our material being able to do this in North America. On the next slide shows another important factor around long life technologies, and it was brought up in a question around home energy storage and the need for that, and as well the balance between electric vehicles and energy storage systems converging in vehicle to grid, which is really going to put even longer cycle life demand targets on electric vehicle batteries. So we see more and more emphasis from our potential customers on the life cycle performance of these batteries for the EV and ESS market. So as we look at the next slide and talk about our growth for the anode materials business, as I said earlier this week, we closed on the purchase of this production site, locally known as Big Blue. We'll install our planned 8,000 plus ton expansion that we funded through our capital raise into this site by 2023, and there's room to grow beyond that, and plan to create about 290 jobs over that time compared to the 30 employees that we have on site today. And of course, we've had great support from the city, the state, as well as the power utility in attracting us to this location for our next production site. On the next slide is a bit more about our Department of Energy award, about $5.5 million toward our new furnace technology. And I think this is a really important nod from the Department of Energy toward the technology we've developed, the industry that we're in, and the need for this technology to be deployed in the United States. This materials gap that's being developed, as Cameron mentioned, is amplified when you look regionally, and especially in the United States. And so in partnership with Phillips 66, a potential provider of feedstock materials, as well as Harper, our furnace partner, we'll look to bring our first third generation system online in the next few months. And as I said on the next slide, this is all to position the company toward this rapid growth that we are executing on over the course of this decade. We funded our phase one 10,000 ton per year expansion that will happen by 2023. And then incrementally, we'll work to 40,000 tons by 2025 and 150 or more thousand tons by 2030. And when you look back to the table of factories in North America, amounting to 350 gigawatt hours of capacity or so, that's over 300,000 tons of this type of graphite material demand in the market in North America alone in 2023. And we're looking to be somewhere between 10 and 40,000 tons of production at that time. So we're feeding a huge supply deficit, as Cameron was indicating, and we're positioned at the front of this market as we're the only people really bringing notable capacity online in North America. And so to wrap up on the last slide, the company is poised well to execute on our technology and bring these to market and begin scaling. Our battery technology solutions business is really a key differentiator for the company, having this visibility across the technology landscape and being a leader in that space. Our anode materials business is scaling now. And of course, our new technologies, cathode and energy storage, are working through their commercialization plans, all in an effort to bring in this exciting decade for storage. So thanks,
Chris. We appreciate you had a lot to get through, very short space of time. Now I've got a question. Someone reached out to me during the week, so I have to go first with this question.
Sure.
How do you think about maintaining the competitive advantage your HPC tech gives you when you lease this equipment out to battery manufacturers? Would this not deteriorate your advantage if competitors have access to this technology?
Sure. So that's something we've thought a lot about. And I think it's important as well to normalize this type of testing in the industry, right? I mean, this is becoming a standard that's used by many of the major cell manufacturers, auto OEMs. They're familiar with the techniques and the technology. And that's important because when we do all of our internal qualification development work, we want to be able to bring data packages to these companies that they understand, that have credibility, and they can see the performance that they're going to get from using these materials. So while it does spread the ability to develop, it's only one of the things that positions Novonix well. And it's important that it's something that pushes the entire industry forward, because the need to accelerate technology across the sector is so huge to meet these decarbonization goals.
I have lots of questions here, so we'll get through as many as we can. Novonix is the only qualified supplier of synthetic graphite in the US, and the recent global supply disruption for superconductors, the conversation around localization of US supply chains must be getting louder. With your EV hub building out of Tennessee, you seem to be perfectly located. Is that fair?
Yeah, there's really a few EV hubs, happening when you kind of draw it out, and the folks at Benchmark do a great job of doing this in their mega factory reports and such, right? In the Southeast, we have LG's new plant that'll be built in Tennessee, SK's plant in Georgia, and others announced as well. Then you have kind of the Detroit local US-based auto hub, and then you have Tesla on the west side in Texas and California. So absolutely, as part of our search for a new site for our phase 1 10,000 ton level, we looked at other locations, but Chattanooga is a great place to be. And as you said, the emphasis from the government, from the customers, from the industry to localize and onshore these suppliers is becoming very loud. And people simply haven't been investing in synthetic graphite technology in North America because of a focus on next generation technology that still has a long way to go before it's commercial.
This question here is that there's a view that synthetic graphite is dirtier than natural graphite, but you're kind of competing with a Chinese synthetic graphite. Can you talk to the green and performance benefits that your product has over the Chinese synthetic graphite?
Sure. So I think the biggest thing is that when we looked at the process technology, it was all about how can we become more energy efficient, more yield efficient in our process, right? So we have a virtually no emission, high efficiency process, even through graphitization, which is a generally speaking energy intensive process. That coupled with the ability to source power from the Tennessee Valley Authority, which have the ability to provide fully renewable power if we want, but has a general grid makeup of about 60% non-carbon, really lead us to an ESG profile that's attractive to people. And the other thing that I think you have to start to normalize is the concept that we talk a lot about things like price and carbon footprint as a static number, dollars per kilowatt hour, kilograms of CO2 per ton of material, right? But how long that battery is in service could dwarf that impact, right? If we are able to produce materials that can extend battery life, let's just say double battery life, for example, well, would you pay 10% more for a battery that would last twice as long if the application warranted it? It would be much cheaper total cost of ownership. So you have to look at the life cycle assessment the same way.
Great point. Now, just finally, the Biden administration came out a day or two ago with a historic infrastructure deal. Specifically, they plan to spend $3 billion with battery material companies. Once again, you're kind of the only qualified supplier of battery grade anode materials. This announcement kind of must put you at the front of the conversation for government funding.
Certainly, it's early days in how that funding will be administered and distributed to different companies and where it will play. There's, of course, a lot of emphasis in lithium and recycling, but they have to support the entire sector. And as you said, there's a limited number of options of these midstream material suppliers like us that have the ability to now become relevant in the sector, right? So we're excited to see those announcements and certainly are looking to where we can take advantage of that, and already being recognized by the Department of Energy for this award this year. You know, we're on the radar of the companies that are going to play a role in this sector, certainly.
Chris, thanks for your time. We have lots more questions, but I appreciate it's probably midnight over there, so we'll try and follow up next week.
Great. Thanks, Tim. Thanks, everyone.
Okay, next up we have EuroMagnus, ASX code EMN, market cap of around $218 million, a one-year return of up almost 800%. The company is a Canadian public company focused exclusively on the development of a new high-purity manganese production facility based on a recycling of a tailings deposit located in the Czech Republic. We have with us the President, CEO and Director, Marco Romero. Marco, welcome back. Thanks for your time.
Thank you very much, Tim. Good afternoon, Australia. Hello from Canada. I am happy to get this opportunity. Oh, my slides have been going by themselves. Get this opportunity to talk to you about something pretty close to my heart here. We have been working for the last 6 years on the development of Europe's largest manganese resource, which is hosted in tailings, which is waste from a decommissioned mine in the Czech Republic. This is a globally significant resource. We have designed around it a 25-year project to produce approximately 50,000 tons per year of high purity manganese in the form of battery grade products. This is very much a recycling project, no hard rock mining, no significant new waste generation. It makes it unique in the world. This has, of course, helped us a great deal because we don't have to have a big open pit and a big pile of waste beside it. Regulators, local communities have been a lot more interested in this project. And in fact, I'd like to think supportive of this project as we've advanced through a series of environmental and other regulatory reviews. We're quite advanced right now, and the lack of opposition to the project has been extremely helpful. There are also significant environmental benefits around the project in that we will be remediating what is an already polluted brownfield site. We will be leaving it in better condition than it is today. Furthermore, as we are located in the center of Europe, we're uniquely positioned to serve a very rapidly growing EV and lithium-ion battery market. Plus, being in Europe in a relatively densely populated area, we're blessed with extraordinary infrastructure. We have rail, major rail, right on site, highway, gas pipeline, water, and power available. I don't believe there's a project anywhere like this anywhere in the world. Next slide, please. We're focused on producing two principal manganese battery grade products. The first one is a manganese sulfate product of an extraordinary purity, which we believe is very important to confer great performance characteristics to the batteries that use it. And the other one is an electrolytic manganese metal product, again, of an exceptional purity. We expect that the sulfate to metal ratio coming out of the plant will be around 2/3 to 1/3. And I should point out that the manganese industry is large. There's over 20 million tons a year of manganese produced, going largely to the steel industry. But the battery grade manganese, the highly refined manganese business, is the fastest growing business, driven principally by the EV industry. And we are very much intent on becoming a significant player on this. Next slide, please. High pure manganese is important to the industry. I just got some updated figures this morning that show that about 52% of the batteries produced in the last year are NMC batteries. And then there are even other batteries in the rest of the that pie that also contain manganese. But manganese is important. It's the lowest cost battery metal in this NMC cathode chemistry. And there's not a lot of incentive to get rid of it, unlike cobalt and nickel, which are expensive. Manganese, in fact, is seen as an opportunity to lower the cost of batteries. It has a great electrochemical features to it. And we now are seeing very clearly in the emergence of new manganese-rich cathode formulations driven by a number of the largest players who are trying to bring down the cost of these batteries so they can sell more cars. Next slide, please. We have seen a very strong trend emerge since we started this project, a very strong focus on environmental and social impact of raw materials production. And our project, with its unique waste recycling aspect and its very European, localized nature, has attracted quite a bit of attention there. We see it as a great opportunity for Europe to supply itself, at least a measure of self-sufficiency with sustainably produced products. And we're very much focused on that, and I'll tell you more about it in a minute. Next slide, please. One of the clear things that we see is that the majority of the manganese products made in the world that are used for batteries are made in China. China was an early mover and was able to develop a very good industry and continues to be the principal point of supply response for these products. But we have an opportunity right now ourselves in being able to skew that balance in a small way, notwithstanding the fact that the anticipated demand growth for manganese for batteries is enormous, as you can see from the graph here on the right. And there is a deficit emerging already, but it'll be cured. So, the price will cure it. And there are a number of projects, among which ours. And that graph, by the way, includes our production on the supply side. So there's a great deal of new manganese supply needed. Next, please. This is a slide I always like to show. It gives you a very graphic sense of our strategic positioning in the middle of Europe and what is becoming a true global hub for EV and battery production. Virtually every manufacturer in Europe needs manganese. Virtually every automaker in Europe has committed itself to battery chemistries containing manganese. And we've got a shot at becoming the only primary producer of these products. Next, please. The process we intend to use entails the use of only proven conventional and commercial technologies. We're not reinventing anything here. We're not going in, taking risks with technologies. The chemistry is well understood. What we are doing is doing it in a cleaner way. We expect to be able to meet every European and Czech environmental standard by simply taking these soft unconsolidated tailings, running them through a wet magnetic separation process, a leaching and purification process, electrolysis, where we can end up with a metal product that can be sold into the market directly in flake or powder form, and converted into a sulfate product that we can sell, and which is in high demand. Next, please. This is an advanced project. Like I said to you, for 6 years, we have been working to bring this project on stream. We have completely drilled off our resource. We have over 98% now of the resource classified as measured under JORC or NI 43-101. We've done an enormous amount of work on metallurgy, bench scale tests. We built a pilot plant, and we are now constructing, as we speak, a 7-time scale up of that pilot plant, which we call our demonstration plant, which is intended to produce large scale samples, multi-ton samples of finished product for supply chain qualification. And we've already signed 5 agreements with 5 groups and are in very active discussions with others. We expect the startup of that demonstration plant in Q1 of 2022. Next, please. We've done a great deal on the permitting front. Like I mentioned to you, we've done a lot of work on community engagement, and have developed very strong, supportive, collaborative relationships even. But also with the regulatory authorities. Last year we filed a preliminary EIA for the project because we made a voluntary decision to go through a two-stage EIA so we can get enough feedback to finalize a strong final EIA or ESIA in our case. And that went extremely well. There was very little controversy around the project, if any, actually, and got a lot of great input, which is now being incorporated not only into the final EIA, but actually into the plant design, little tweaks, small things that improve the project. And we're expecting to file that in Q1 of 2022, if all goes well. Perhaps in as few as 6 months after that, we could have this approved and green lighted. Next, please. In the design of this project, we've incorporated a great deal of very progressive environmental practices. A lot of it is really a result of the unique nature of this deposit, this unconsolidated old waste that's just sitting here. So there's no need for crushing, grinding, or hard rock mining for that matter. We've really strived to make sure that this project is well integrated into the local community. A lot of focus on the long-term reclamation of the project, bringing it back to long-term productive community use. We've been evaluating quite successfully, I must say, the opportunity to acquire renewable and CO2-free power, which would further reduce an already small environmental footprint for this production. We have been doing testing recently on the capture reuse of CO2 and hydrogen that comes out of the process itself, so that we can essentially make our own reagents and prevent having to buy other externally produced reagents. Importantly, the plant will be generating zero effluent. We expect to recycle all our water. Our only losses are through evaporation and the moisture that reports to tailings. That's just very, very helpful with the design of the project and the acceptance of it. We also expect to use zero fresh water. We have opportunities to use contaminated or industrial wastewater. And all the work we've done so far indicates that that is ideal. So no fresh water use, no water taken out of the aquatic environment. Next, please. In 2019, we published a PEA, Preliminary Economic Assessment under Canadian regulations. We estimated a CapEx of $404 million US, and after-tax net present value of 593 over a 25-year life project with a after-tax 22.6% IRR. We have seen great strength in the market for these products and expect that we will be able to continue with strong economics as we now move into our feasibility study, which is scheduled for completion again in Q1 2022. Next, please. Tim, I lost track of time, so if you want to signal how many minutes I got left with your fingers.
1.
Oh my God, I better hurry up. Look, there are many strategic advantages to this project. This company's in good shape, moving quickly right now. We've got this chance of becoming this only primary producer of high purity manganese products in Europe. Great deal of interest from customers, and we expect to be able to develop some very supportive relationships there, which will help with project finance. We believe that this project is unique in the world and an ideal way to invest and participate in the growth of a high purity manganese market. Next, please. Very quickly touch on our schedule. Look, we're targeting production in late 2024, early 2025, after an 18 to 24 month construction period. A lot of the heavy lifting in setting the stage for that will be done this year and in 2022 with the completion of the ESIA feasibility study, supply chain qualification, and as we hope, the binding offtake agreements that will facilitate permitting and perhaps even support from government or European Union bodies that would very much like to see the localization of supply chains. Next, please. Final slide. Our company is listed on the ASX, of course, as well as the TSX Venture and the OTCQX. We have about a $220 million market cap and very well funded, enough to get us through all that work that we put in front of you for 21 and 2022. And next slide. Thank you very much, everyone. Sorry, I went perhaps a little over my time.
Thanks, Marco. That's fine. Now, did I see today that the Czech government and the energy company SES announced they were looking to sign a memorandum of support for the building of a gigafactory in the Czech Republic?
Yes, ČEZ, which is the national utility company, which is 70% owned, and the Ministry of Industry and Trade signed an MOU where essentially they're making available together renewable energy and cash to attract, to incentivize a large gigafactory, being built in the Czech Republic. There's been all kinds of speculation as to whether it's going to be won by an automotive company or a large battery company, but it's all encouraging, and it all plays into that local battery supply chain narrative that it's happening all over Europe. It's happening in France, in Germany, in Finland, in Sweden, Poland, Hungary. It's all around us.
And now, for those who don't know, Czechoslovakia is a major auto manufacturer in Europe. Always about 120,000 people. They manufacture the Skoda, which is a subsidiary of VW. Now, VW obviously want to be the dominant power in Europe in regards to EV market share. They're going to use a manganese-rich battery cell. Is that right? And does that play into EuroMagnus' hands?
Look, there's been statements, there's been announcements made by virtually every major auto player in Europe. Volkswagen's was in March when they announced that their mass market vehicles would have a manganese-rich battery. More recently, Stellantis, which is Fiat, Peugeot, Renault, and all the American brands, Chrysler, Jeep, and many others, also made a similar announcement that all their battery chemistries will have manganese in them. So yes, we see the overall demand for these products growing very, very rapidly in Europe and beyond. And even though we've got a shot at becoming one of the largest producers of these products in the world, we will still not be able to satisfy European demand or even come close to it, to be honest.
Thanks, Marco. That's all we have time for. Enjoy your dinner with your family, and we'll see you soon.
Thank you, Tim. Thank you, everyone.
Okay, next up we have Lake Resources, ASX code LKE, market cap of 438 million Australian dollars. The company has had a one-year return of up almost 1,100%. The company is a clean lithium developer utilising clean, direct extraction technology for the development of sustainable, high-purity lithium from its flagship Kachi project. We welcome back Steve Promnitz, who is the managing director. Steve has some internet problems, so his camera will remain off. Steve, over to you.
Thank you very much. And it's a real pleasure to be back here again. I must say it's an impressive group that's been put together, and it's a pleasure to have that headed up by representatives Benchmark and one of our great companies that we work with, Novonix. What we're doing, first of all, if I could just talk about where a lake is positioned. We're in the lithium triangle. This is where very large projects are based, generally at the low end of the cost curve. And all of the 5 major players are here. We're fortunate in having a very large property position, 2,200 square kilometers. I'm going to be talking about our flagship project, Kachi, which is just down the road from the longest term producer here, Hombre Muerto, which is Livent's operation in country. Next slide, please. What we do at Lake is fundamentally different to others in the lithium space. We're focused on producing a cleaner lithium and doing that with ESG benefits. So if I go back in time a little, we put this company together back 2015, 2016 with these assets. And by the time we were drilling our major project, Kachi, we could see it was large, but the end users were telling us that they needed a consistent, clean, high quality product. And we heard references to that both from Benchmark and some of our earlier presenters. But the only way to do that was to use a new technology. Using the current technologies just wasn't going to cut it. And that's why we went down the path of hunting around, finding a direct extraction method, and we settled with Lilac, who use a very well-known form of water treatment called ion exchange. The benefit of ion exchange, not only was it well known and it's been widely used for 70 plus years, they had just adapted it for lithium. And so we could replace these big evaporation ponds with their direct extraction process. And in the process, just take the lithium out of the water rather than concentrate all the salts. And through that, we could develop a much cleaner way of processing it, much less water usage, much lower land usage, but best of all, produce a very consistent high purity product. Now we've gone through the path of pilot plant testing. We've gone prior to that benchtop testing. We aim to have a demonstration plant on site towards the end of this year. We're currently in debt finance discussions. We're currently in discussions with off-takers, a detailed feasibility study underway, and targeting financial close for middle of next year and production first half of 2024. But the key differences I want to emphasize here is high purity, scalable with ESG benefits. Next slide, please. So what does that look like? As I was saying before, up here on the top right-hand corner, this is a traditional method. You pump out this, or imagine something like Death Valley in California, this arid dry salt lake. You pump the salty water from underneath it. That's where the lithium is dissolved. And at the moment you put it in an evaporation pond, you concentrate all the salts, the water gets evaporated away, and you separate out the lithium. Nothing wrong with that process, but it's been around for many centuries. What we're doing is using something that was developed in the 20th century and adapt it for the 21st century. Pump out that water, just separate out the lithium using ion exchange beads. That means we can return that water back to its source. By that very fact, we produce a very high purity product, and then that gets cleaned up into lithium carbonate. Next slide, please. And over these next 3 slides, I'm going to show you what that means from an ESG perspective. First of all, instead of evaporation ponds heading out across the horizon, covering 10, 20, 30 square kilometers, we're talking about something which is the size of 1 or 2 city blocks. So much smaller land usage. Next slide. And at the same time, instead of all of that water, albeit non-potable, it's salty, but instead of all that water being evaporated away, we return virtually all of it back to where it comes from. So orders of magnitude difference in the use of water, orders of magnitude difference in the size. Next slide, please. One of the benefits that all the brine producers do have is generally a small carbon footprint because they use power of the sun, but most of the plants are powered by natural gas to convert into carbonate. We're looking to use most of that as a solar PV farm. And so all of these brine evaporators have a small carbon footprint. Ours is probably going to be smaller, but in comparison to hard rock, again, a number of orders of magnitude smaller. Because we don't just look at digging a hole in the ground, we have to look at the fact that that's then processed into hydroxide, which is highly energy intensive. Next slide, please. The other great thing about using direct lithium extraction is it's modular, and so you can scale it up easily. We have a pre-feasibility study out that shows that we can operate at 25,000 tonnes per annum. We're now expanding that to 50,000 tonnes per annum, and that's been driven by demand and also the support of debt. Next slide, please. Of course, we have to demonstrate our product is high quality, and thanks to Novonix, they demonstrated that this product works very well in initial testing in NMC 622 batteries. We aim to be doing more work with them in the future, and I want to have a shout out to Novonix, an outstanding company if you get a chance to have a look at them. Next slide, please. And one of the beauties of producing a high quality product is you get a consistent high margin. And I'm talking a serious high margin. Some of the lithium brine producers at the moment might be making $1,500, maybe $4,000 a tonne margin. At the moment, we could be making anywhere from $8,000 to $10,000 a tonne margin. That's because a consistent high quality product that doesn't need to be reprocessed. There's nothing wrong with the other products. They just normally need to be reprocessed into its final product. Next slide, please. So what does our project look like? It looks like any of these other brine basins. They're large, it's dry, it maybe rains once a year, once every 5 years. Our key difference is we basically own the entire basin with mining leases. Our current resource is large, but only 20% of that is for 25 years of production. If we double production, we can do that easily enough. And that's why we've got the rigs back here to support that. It really is, we've got the opportunity to develop this to really the size that the market wants. Next slide, please. And throughout the pre-feasibility study that we recently refreshed, the numbers are really quite compelling. A post-tax NPV8 of 1.6 billion US, EBITDA line of 260 million a year. With the debt servicing and the conversations we're having with debt providers, we might only need 50 million of that each year to service the debt over 10 years. It really becomes quite a compelling project. And if we scale it up to 51,000 tonnes per annum, our operating costs come down and that post-tax NPV will look even better. Next slide, please. So if we look at our timeline, we're doing the bread and butter issues at the moment: definitive feasibility study, environmental social impact assessment. That's due first quarter next year, maybe the ESIA a little bit later than that. We need to do that so that we can secure the finance. Before we finish the DFS, you can expect the demonstration plant on site. It would be there now if not for COVID. We've been operating a pilot plant for some time in California. We're more samples off to battery makers and potential offtake partners. We're currently in discussions with project financiers. They're predominantly export credit agencies. We're talking 10-year debt, 70% of it being funded, and interest rates around 3%. And then when we go through financial close, the middle of next year, moving into construction and then production for first half 2024, and quite possibly the expansion case soon after. Next slide, please. Where are we at the moment? We're valued about 400 million Aussie, about 300 million US. We've got cash in the bank to take us to financial close and then some. Share price about 40 cents. And it's been fairly solidly supported since February. Next slide, please. But there's still significant upside. If we look at our peers, we're trading 15–20% of NPV. Our peers are trading 30 to 80%. Our closest peer is an excellent company called Standard Lithium, ticker code SLI on the New York Stock Exchange. $1 billion market value. They only own 30% of their project. We've got price targets, many orders of magnitude where we are at the moment. There's a lot to come down yet. So watch this space. Next slide, please. And so to finalize what we're doing, we need a lot of lithium, whether that's 10 times, whether that's 15 times over the next 10 years. But what we're doing is producing a consistent high quality product that we know the end market wants. We're producing it with new technology so that it's consistently high quality, And with that, we get major ESG benefits. And I have to say, this is what's driving the conversations that we're currently having with EV makers and battery makers that want to see this in their supply chain. And that echoes some of the comments you heard from EuroMagnus and also from Benchmark. So on that, thank you very much. I hand it over to questions.
Thanks, Steve. Now, you recently announced the issue of bonus options, which I don't think too many shareholders quite understand what bonus options are. Can you explain how that works for a shareholder of Lake?
Certainly. If I can provide some context, we did a capital raising in January this year over the Australia Day long weekend, and shareholders breathed a sigh of relief because we were finally financed through to our key investment decision in the middle of next year. But some of them were not entirely happy that they didn't get a chance to participate in that. So what we wanted to do is to thank our shareholders and issue them a bonus option. At the moment, we're only able to do that under Australian securities law, but we are looking at ways where participants from offshore can share in that as well. Believe me, we'd like to do that. How it works is on the record date, which at the moment is indicatively the 10th of August. If you own shares in Lake, let's say you own 100,000 shares, then you get 10,000 bonus options. It's a 1 for 10 offer. You don't have to do anything. They'll just turn up on your register. And when we get around to the weeks leading up to the 15th October, each shareholder would then need to make a decision. Do I exercise some of those options, all of those options, or none? And if you do, you pay 35 cents to buy and convert that option into a share, and you pay that money to Lake. You get a share at 35 cents, and then you also get an additional option with a 75 cent exercise price and expiry in June next year. And we aim to have those listed so that they would then be tradable about 6 weeks later. The idea of that is that shareholders who are currently on our register get to participate. Looking forward, if and when we do a capital raising somewhere between now and next time next year, that'll predominantly be with institutional funds. This is a way where they can share in that. We're looking to do a raise of about 100 million US by the middle of next year. We can see that a chunk of that change will probably come from these bonus options and their conversion. And so it's a way to both thank shareholders and also to have them engage with us going forward. And you can see from where we expect the share price to go, we also reasonably expect those options at 75 cents to be in the money by the middle of next year.
Thanks, Steve. Now, the ongoing exploration is designed to obviously increase the resources and to underwrite a doubling of production. However, this data is kind of not in the DFS. Is this likely to change given the strong demand for lithium globally?
So the short answer to that is yes. If you'd asked me that even 2 months ago, I probably would have said no, but we're drilling at the moment both to provide the DFS with the robustness that's required for project financing. That's to convert some of the resources into reserves, but it's also to upgrade resources into measured and indicated. We're quite confident that's going to happen. Honestly, it's just a matter of number of wells and hole density, and then we'll be doing pump tests on that. The key things that we were looking for was that the off-takers wanted to see that extra demand, and pretty much the conversations we've had, they want to buy everything we're going to be producing for the first 5 or 6 years. So we probably need to be producing more. And then the debt providers are quite keen, if possible. Indicatively, they've shown support to that expanded case. So the DFS will probably come out with a second option showing that expansion case.
Great, Steve. That's all we have time for. Appreciate your time and have a nice weekend.
Thank you so much for the opportunity.
And a slight internet problem there, we apologise for as well. Next up, we have Queensland Pacific Metals, ASX code QPM, market cap of around $200 million. The stock has had a positive return of 725% over the last 12 months. The company owns the Townsville Energy Chemicals Hub, which they call the TECH project. The TECH project will be an advanced, sustainable producer of critical chemicals for the lithium-ion battery and EV sector. We welcome to the webinar series Stephen Grocott, who is the Managing Director. Thanks, Stephen.
Thank you very much, Tim. Good morning, good afternoon, good evening, depending upon where you are. Thanks to ShareCafe for the opportunity to talk about this. If you fall asleep after this, that's okay. You've got the gist of the project. For those of you who are unfamiliar with the tech project, we'll be importing high-grade nickel laterite ore from New Caledonia, 7-day shipping from the port of Townsville. That's from the same mines into the same port that they exported for many decades into the now shut down Queensland nickel refinery. We have nothing to do with that refinery. We use a totally different process. The only thing in common is we're getting the same ore from the same mines. We use a different process. It's called the direct nickel process. It uses nitric acid to leach the ore. Nitric acid's a great solvent for dirt, dissolves everything except the silicates, which are a nice inert residue that you can deal with. It dissolves everything else, including, of course, the nickel and cobalt. We'll process them through into a mixed hydroxide precipitate, which is saleable in its own right. It currently sells for about 90% of LME. If you don't know that, you should subscribe to Benchmark so you can get the data. We'll refine that on site using conventional nickel and cobalt refining processes directly into the high purity nickel and cobalt sulfate direct into the battery industry. The direct nickel process, we recycle the nitric acid, so it's a very low cost process. As a byproduct of that process, we don't do anything special. The iron that's in the ore, and that's 40 to 50% iron, gets converted into a high purity hematite, effectively an iron ore fines, which we will pelletize and sell directly into steelmaking. It's a premium product. The magnesium in the ore ends up as magnesium oxide. Again, we don't do anything special. It's a byproduct of the process. That's saleable, of course. The aluminium in the ore ends up as aluminium hydroxide, and that's a free feedstock into a high purity alumina refinery, which will operate on site as well. So in summary, we've got high grade ore coming from established mines in a safe jurisdiction. We have a very clean technology process. We recycle the leach agent, so it's low cost. All of the unit operations are using off-the-shelf equipment, using standard unit operations. We have no mine, so we're very fast to market, producing directly the high purity value-add products directly into the battery supply chain. So sounds fantastic. And you might say I'm biased, and well, of course I'm biased. Everyone is biased. The real issue is which is the best bias to be biased with. And I think the bias of the world's largest lithium-ion battery producer and 2 Fortune 500 companies is perhaps a good bias to be biased with. On to the next slide, thank you. So for many months, LG and POSCO investigated us. They undertook a thorough technical and whole of project due diligence study. That led to them investing $15 million US into the company. And accompanying that, we signed a very clean, simple, binding offtake agreement for the nickel and cobalt production as nickel and cobalt sulfate. That's for about 2/3 of our production. So we've got some world-class partners, and those binding offtake agreements form a foundation for the funding of the entire project. When we first started discussions with them, they said, can you do this bigger and can you do it faster? And we said, yeah, bigger is easy. In fact, about 2.5 to 3 times bigger is the optimum size. So we increased the size accordingly. They said, can you do it faster? We said, yes, we can do it faster, but it's going to be more expensive to do the feasibility study faster. You need to have skin in the game. So we shared that risk. We raised 20 million on market. They came in with 15 million US, about 20 million Australian equivalent. So skin in the game with 2 of the world's best partners you could ask for. We also commenced a feasibility study with Hatch, a tier 1 engineering partner. But rather than my words, next slide, we'll go to the words of LG and POSCO. So as I said, you know, LG are the world's largest lithium-ion battery producer, supplying the likes of Tesla and GM and so forth. We're now part of their supply chain planning, a very good position to be in. Many of you wouldn't know much about POSCO. They are Korea's #4 company. They recently invested into First Quantum's Ravensthorpe project, 240 million into that. They're a very big nickel miner in their own right in New Caledonia and a big producer of ferronickel and nickel products into the stainless steel industry, but they're also growing in the lithium-ion battery chemicals feedstocks. So we think we've got 2 fantastic offtake partners, and that they have identified the benefits that the tech project can bring. One of the things that attracted them were the sustainability credentials. We've heard much of that today. Next slide, thank you. Now, you can read the words yourself, but basically what the table in the middle says is that the greenhouse gas intensity of nickel production through the Teck project is around about 1/3 lower than the global average for nickel in nickel sulfate. Now that global average excludes, surprise, surprise, any Chinese production and the Chinese Indonesian production, which is substantially greater. So our greenhouse gas intensity is quite a lot lower. In fact, with the likelihood that we are sourcing gas from that is currently being vented and flared from metallurgical coal mines, we are likely to be zero or more likely to be negative greenhouse gas intensity. And that's a remarkable position to be in. That follows conventional ISO, LCA regulations and guidelines, and we've used a global company to do the LCA for us, ISO compliant. So low greenhouse gas intensity, but perhaps even more important to many nickel end users is the fact that we have no tailings. We have an inert filter cake that is being investigated for alternative uses. We produce about 0.2 tonnes per tonne of ore of that filter cake, and we may well have 0 tonnes of residue. Compare that with high pressure acid leach, which also can feed directly into the battery supply chain. That produces 1.2 to 1.4 active tonnes of tailings for disposal. And in some cases, sadly, for disposal into the ocean. So it mightn't seem logical to you, but people don't care where the nickel comes from that goes into their kitchen sink. But the end users do care where the nickel comes from that goes into their EV. Nobody wants to get into an electric VW in Frankfurt, knowing that the 50 kilos of nickel in their battery pack is responsible for 5 tonnes of tailings in the ocean. So if you've got your capital right, your risk right, and you tick the sustainability boxes, investors come knocking. And that's what happened to us in relation to LG and POSCO and others that we're in discussion with. Next slide, thank you. And this just shows some of the products that came from our pilot plant campaigns that we completed earlier this year. All of that piloting was included in the LG technical reviews. The direct nickel process that we piloted had already been piloted many times before, but we undertook a couple of pilot plant campaigns on the same ore that we will be processing at commercial scale. And no surprise, we proved up the process and we produced the intermediate product that was sent to an LG refinery, which proved up the specifications. Next slide, thank you. That just shows that the pilot plant is real, or that I'm a good photographer. This pilot plant was run for a couple of months. It needed 20 operators around the clock, ran for several weeks. So we have a very good process, but just as important as a good process is to have a good location to build your processing plant. Next slide, thank you. If you're going to write a script for a good location, this effectively is the script. This location is located 40 kilometres south of the Port of Townsville. There's a skilled workforce, underutilised skilled workforce in a very attractive location. On our eastern boundary, there is a highway, a railway line, and an almost empty natural gas pipeline. We are zoned heavy industrial. The land is already cleared. Cultural Heritage Management Agreement is already in place, no native title. The environmental approvals are pretty straightforward. So that is a perfect location. You've got everything that you need. What I haven't talked about is our technical team, our team. Next slide, thank you. I've worked for many fantastic companies, including Alcoa, BHP, and Rio Tinto, and I've worked with some very good people, but I've never had the privilege of working with such a high quality, highly experienced, capable team. You only get people of this caliber by having a very good and a very attractive project. People with this experience and background sometimes don't like working for some of the companies that I've worked with in the past. You know, they want to be able to utilize their experience and capability to the full extent. So this team of people recognize that this is a relatively low risk project coming on board at the right time with the right technology at the right time in the market. Not shown here are 2 of our ExCo members, our CFO, and our General Manager of Corporate Development, both of whom have got decades of experience in the resources sector, getting projects up and running. Onto our project timeline. Next slide. Thank you very much. So as I mentioned before, our pilot plant was concluded successfully earlier this year, completed in May. Our project approvals are underway. We commenced that late last year. Now, we have, in relation to approvals, we have no mine, no native title, no process effluents, no tailings. So approvals, we have no worries, as an Australian would say. So approvals we expect to be in place by the end of this year. We started a feasibility study with the Tier 1 engineering partner, Hatch, and that feasibility study will be complete early next year, and that will deliver a +10, -15% capital estimate. Now, we're fast tracking that feasibility study. Now, as an investor, when you hear somebody say fast tracking, you should panic, because what normally happens is people cut corners, cut costs, and beat up their engineering partner who rolls over and plays dead. We're fast tracking by spending a lot more money on this feasibility study than a normal junior would spend. And we're doing that so that we can undertake activities that wouldn't normally be done in a feasibility study. So we've got very early engagement with vendors and equipment suppliers. We have got a detailed engineering commencing early, and we'll be ordering long lead time equipment early. So we fast track the entire process so that we, at the end of the feasibility study, we don't demobilize and then start all that stuff. At the end of the feasibility study, we continue, so we don't have to remobilize and re-engage the key engineering partners. We're appointing a debt advisor next month, and we aim to have that debt processes all sorted out by early next year for construction starting just before the middle of the year. 18-month construction and commissioning with first production by the end of the year. So next slide on the corporate overview. A year ago, our market cap was around about 13 million, and we had a good feasibility study, which was the culmination of a couple of years of very good work. Our progressive growth through since then, up to the current market cap of a couple of $100 million, hasn't been by razzmatazz, but by progressive box ticking. So we said we'd develop a draft ore supply agreement, tick. Non-binding MOUs, tick. Starting our approvals process, tick. Completing pilot plant runs successfully, tick. Producing on-spec product, tick. Building a top-class team, another tick. Developing a DFS with a top Tier 1 engineering partner, tick. Raising capital, tick. Developing binding offtakes, tick. These are all things we said we'd do and did. Getting partner investment, another tick. So our growth shows that when you do what you say you are going to do, the market recognizes and rewards it. And we're just continuing the ticking. And the next ticks will be to finalize the DFS, the approvals, start the funding process. More ticks that we're planning on. So last slide, just wrapping up. So just wrapping up and summarizing. So we have tier 1 mines from a safe jurisdiction. They've been operating for decades, importing into Townsville, where that ore's gone for many decades before, into a great location with a great process and a great team of people. And importantly, the sustainability credentials are very, very hard to beat. And of course, the thing we don't control is the market. And frankly, you couldn't ask for a luckier time to be doing this project, but I would rather be lucky than clever. Thank you very much.
Thanks, Stephen. You make your own luck. Congratulations on a great Australian story. A couple of questions here. What agreements do you have to guarantee the supply of ore from New Caledonia?
So we have 3 draft agreements with 3 different miners, SMGM, SMT, and also with EuroMagnus. There are 6 miners over there. They are the 3 biggest ones, I believe. And my predecessor, who's an executive director, worked over there with those miners, and we just piggybacked on existing previous agreements that Queensland Nickel had. So that's pretty safe jurisdiction. Very much relationship based. That's very important. I neglected to mention that POSCO are a very large ore miner in their own right in New Caledonia. We haven't had discussions with them about that, but that's also another option. The good thing, and it's a very good question, is New Caledonia produces a lot of ore, but it tends to be the bottom half of the ore body, the saprolite, which goes into pyrometallurgical processing. The top half is almost like a waste product. The only home for it is high pressure acid leach, and that's sort of out of love at the moment. So we're actually coming along. We could take either the top half, the limonite, or the bottom half, the saprolite. But what we're doing is we're actually manna from heaven for these guys, because currently they're high grade limonite ore. They don't have a home for it, and we're coming along and saying, here we are.
Now, Magnus Energy Technologies is also building a plant up there. Have you had conversations about supplying raw materials to them?
So the Magnus project, if that goes ahead, they will be importing their precursor cathode active material. We will be producing the nickel and cobalt sulfate, which goes into the manufacture of the precursor cathode active material. So there's a one-step gap between us. So unfortunately, there's a gulf between us. We have had chats with them about some potential other synergies around services and so forth. But in terms of the supply chain, until there's somebody who's going to be producing PCAM from our material, there's no synergy there. Our plant layout is designed so that we could build a second train, and that would be large enough to support a PCAM manufacturer on that site. But that's getting ahead of ourselves.
And there's kind of a technical question here. I know we've got a couple of analysts online. The D&I process that you're using has a low carbon footprint. It's quick, less wasteful, no tailing dam is required. Now, with regards to battery performance, how does your class 2 nickel product compare, and where does it sit on the cost curve?
So it's a class 1 nickel product. It's just high purity nickel and cobalt sulfate, the same as anyone else produces, however they're producing it. So it's the 3 ppm of iron, and the 2 ppm of this, and the 20 ppm of cobalt in the nickel, and so forth. So it's just the high purity feedstock. So it's exactly the same as nickel and cobalt sulfate produced by BHP in WA or Terrafame in Finland. It's no different.
Sure. A question here also, is the conversation with Samsung SDI still going on?
Yes, in fact, we had discussions with them last week. We didn't sign the binding offtake with them. It's you go with the people who you speak to first. But listen, Samsung are a great partner, and they made contact with us for further discussions next week. Obviously, we've still got some production that's not spoken for. Whether we want to lock that up with a binding offtake or not will depend upon our investors. We'll take guidance from them about how that should be treated. But Samsung are certainly still a valuable partner, and we're in discussions with them.
Great, Stephen. That's all we have time for. As I said, a great Australian story. Congratulations, and we look forward to hearing from you again.
Thank you, Tim.
Thanks, everyone. That's all we have time for. A really informative and fascinating webinar about a very important industry. Have a nice weekend, and we'll see you next week.